the data coming out pretty mixed. You got to wonder what it all means for the Fed.
Yeah, it's certainly, I think you're hitting it straight on the head. They're going to have to parse through a number of different data points. They don't want to commit either way at this point. So I think they want to leave open the possibility of potentially raising rates even slightly higher than where they are today, although we think that's probably just nothing more than show at this point. It's not going to materially alter the path that the U.S. economy is on. You see the CPI numbers starting to weaken. You see it's a pretty steady glide path. I think the Fed doesn't want to necessarily crater that and speed that up any faster. I think they're comfortable at the pace, but they just want to make sure that pace continues.
It's been pretty wild, especially for the bond market, and then throw in the auctions that we're seeing this week. What would be the impact? I mean, what are you expecting?
So we're expecting, so when CPI data, for instance, this week, we're looking at data release by data release. We're down to the point now where we're trying to figure out on a monthly basis just where we are. So if you look at the CPI numbers, the core numbers this week we think are likely to come in slightly hotter than expected. So 0.3% month over month. And that's purely a function of just in the last month we've seen energy prices increase, particularly in the form of oil. But if you look at just the core inflationary numbers, those should actually start to fall off a little bit more. We think it's going to be slightly weaker than consensus, just slightly under 0.2%. But you're starting to get into really granular data, which is a good place to be. The other big existential factor here we have to keep in mind is what's happening in China. With the deflationary pressures that we're seeing there, they're not exporting inflation to the rest of the world, which is really helping other central banks around the world to coordinate policy, and that's been very helpful.
Robert, what do you make of this correlation coming out? You know, stocks are following bonds to the downside of late. You know, where does that leave you when you advise clients?
It's when we've been talking about this for the better part of this year, which is last year, the traditional asset allocation strategy failed us, right? It was the first time in many years, in fact, I think it's only happened 3 times in the last century, where stocks and bonds have both fallen in the same markets. This year has been much the opposite story, just as we expected. And so our biggest advice and our strongest advice to clients right now is it's impossible to try to look at these markets in isolation, to look at bond markets one day and then look at equity markets. Our best advice is to make sure that your overall allocation is checked. And the traditional, I hate to call it the 60-40 balanced portfolio, but boy, that has really come back into vogue this year and has helped our investors to sleep better at night. And so our recommendations to clients are to continue to follow along that strategy. Make sure your allocation is filled up. And then from there, we can make tactical decisions.
Yeah, so do those tactical decisions mean looking outside the US? I mean, you know, it's been a FOMO rally. Does it have legs? And if your view is a little bit skeptical, do you look for value in other places? And if so, where? And what kind of industry groups?
Yeah, absolutely. I think that's exactly it. So you don't have to necessarily leave the U.S. entirely, although the value gap outside of the U.S., it's certainly really attractive, probably more so than it has been in the past 20 years. But even within the U.S. markets, looking just beneath the surface of the Magnificent Seven, if you look at small and mid-cap companies right now trading at about a 30% valuation discount to their large-cap peers, there are opportunities that abound even in U.S. markets. It's just, it takes a little bit of additional diligence to be able to figure out how to access those parts of the market. Leaving the U.S., you look at European and UK shares starting to really look attractive. Again, that valuation discount. And then if you look all the way to the east and you look at Japan, for example, structurally, we think that there have been such dramatic changes there over the course of the past 18 months that we think that now is the time to be buying on dips in Japan. So we're advocating those areas which are a little bit off of the beaten path, even though the big Magnificent Seven seem to be taking about 80% of the headline share right now.
Isn't it risky to be buying into small and mid caps when it's still uncertain what the Fed is likely to do? We heard Bowman saying today, you know what, rate rises is going to be coming soon too.
Yeah, you think so. But interestingly, if you look historically at the beginnings of bull market cycles, which we think we are at the very inception of right now, when you look at that, the best time to be invested in small and mid cap is early in that cycle. It tends to price itself well in advance of actual market turns. And so while the rhetoric is that we could be seeing slowdowns, actually the valuation in equity markets happens much faster than those announcements can possibly come out. So we're still very supportive. We don't think that now's the time to be going massively overweight, but we think so many investors are just significantly underweight that sector. It's time to bring it back to neutral weight.
And the dollar.
This is the story that keeps on giving. We're likely at the inflection point. We have been in the dollar. It is going to be so structurally difficult for the U.S. dollar to strengthen from these levels. It could go up slightly from here, just given what happens with the yield curve control discussions in Japan. But it's going to be really challenging for the U.S. dollar at this point in the cycle to continue its streak of outperformance. So likely past the peak now.
Robert, What about, you can look at China. It's not really... What's going to get people to invest in China now? That's my fundamental point here. And, Japan's getting all the headlines, but again, you're going towards richer valuations the whole time, are you not?
You are. You're getting to valuations. Now, fundamentally, the growth and the valuation is tough because it's a rearward-looking metric. But what fundamentally has changed in that market in Japan is actually something that's most exciting to us. However, going back to China, which is the topic on tops of every investor's mind right now, which is what's going to change, what's going to be the catalyst that breaks that market loose. And quite frankly, it's a pretty well-known metric, which is you're not going to see a big bang government stimulus policy, but the cumulative effect of a number of different policy procurements are going to help to stimulate that market. The question is how quickly can they coordinate this? Our view is it's probably not going to happen in this year. You'll start to see some positive green shoots in the market towards the year end, but really the real breakthrough you're going to see in Chinese markets is going to happen in the first quarter to the first half of next year. That again is going to have to come from stimulating the consumer in China. You're going to see the trade-weighted data coming out here in a couple of days. We're not overly optimistic that that's going to be a very positive number, but it's just going to spur even more forceful rhetoric coming from the government and then actual policy follow through from there.
I don't mean to be a party pooper, but could investors be downplaying or underestimating the risks out there? We talk about how there isn't likely to be a recession in the U.S., but we also know that there is a lag effect when it comes to the tightening. 12, 24 months, perhaps. You may not see a recession today, or this year for that matter, but you may see it down the road in 2024. Yeah,
look, you could. Our view is we have probably skirted the overall, when you think about traditional recession, the V-shaped recession, where all sectors of the economy in the U.S. start to dip at the same time. We think we've probably likely avoided that given the policy that's been in place and the slow and gradual increases by the Fed and their willingness to stand by their policy. Had they misstepped at any point and said, we're going to back off of policy, they could have possibly contributed to something that overheated again, and then the Fed had to be more forceful on the other side. We don't think that's likely the case. What we see more likely is something we call rolling recession, which is different pockets underneath the surface of the U.S. economy that are in recession at different times. Right now, that's manufacturing as companies are spending down their inventory or selling off their inventory. That's going to likely reverse. So services are up right now, manufacturing's down. By the early part of next year, that probably reverses itself, where companies have to rebuild inventory and services do begin to slow.